Every December, I hear the same thing from business owners. Christmas is expensive, staff parties, gifts, time off. But here's the truth most people don't expect. The biggest Christmas risk for businesses isn't the party, it's cash flow and compliance. And every year, I see good businesses get caught out not because they did anything wrong, but because they didn't plan for how Christmas actually works. So today, I'm only going to talk about the things that specifically go wrong at Christmas, not general tax theory, just real-world issues. Let's start with the real cost of Christmas. It's not gifts, it's payroll. In December, many businesses are dealing with early wage payments, more public holidays, penalty rates, and overtime. And suddenly, your wage bill jumps while the money goes out earlier than usual. I've seen plenty of SMEs that look fine on paper, but still feel squeezed in the last 2 weeks of December, simply because payroll hits harder and sooner. That's why I always recommend keeping at least 2 weeks of wages in cash buffer, double-checking award and penalty rates, doing a quick payroll review now, rates, loadings, allowances, smarter rostering to control unnecessary overtime, STP, early pay, and same-day reporting. Here's another Christmas trap.
A lot of business owners think, if I pay early, I can report later.
Unfortunately, that's not how STP works. STP must be lodged on the same day you pay wages. Early payment doesn't buy you extra reporting time, and during Christmas, when people are on leave, STP is one of the most commonly missed obligations. My advice: payday, Kakstru STP, day. Make sure someone is responsible during the holidays or outsource payroll over Christmas if needed. Super, 1 day late. No deduction. This one hurts. If super is paid late, even by 1 day, it's not tax-deductible penalties and interest can apply, and Christmas is the worst time to cut it close. Banks are slower, clearing times are longer. Public holidays get in the way. The safest approach: pay super early and don't rely on the deadline. At Christmas, the real pressure on SMEs isn't tax rates, it's timing. Early wages, penalty rates, STP, and super all hit at the same time, and that's where businesses feel the squeeze. Now let's talk about what everyone asks about. I'll give you the conclusion first. Most Christmas parties are not tax deductible. ATO's logic is simple. If it's food or drink provided to celebrate Christmas, it's considered entertainment. That includes restaurant Christmas lunches, office parties, even just pizza. Team drinks, taking clients out for a Christmas meal. Location doesn't matter. Who attends doesn't really matter. If it's a Christmas celebration, no deduction, no GST claim. Sometimes it may not trigger FBT, but no FBT does not mean deductible. That's a very common misunderstanding. Now for the good news. Christmas gifts are usually far more tax-friendly than parties. If the gift is a non-entertainment item, a physical gift, under $300 per person, then in most cases, it's deductible. GST can be claimed. No FBT for employees. No FBT for clients. Examples that usually work: wine, gift cards under $300, hampers, coffee or tea gifts, skincare or product packs. What doesn't work? Anything experience-based, movie tickets, theater or musical tickets, spa vouchers, sporting event tickets. A simple rule to remember: physical gifts usually work. Experiences usually don't. Christmas spending isn't the problem. Unplanned Christmas spending is. If you're a business owner, now is the right time to review. Payroll timing, super payments, Christmas expenses before the holidays start. If you're unsure whether something is deductible or whether a payment creates risk, it's always better to check before Christmas, not after. If you have tax or business compliance questions, feel free to speak with your accountant or reach out to us. We're happy to help you plan ahead.